I think people should avoid using credit cards as a piggy bank to be raided.
Imagine a world where the stock market crashes, sending shockwaves through the global economy. What if this time it's worse than ever before? The legendary investor Warren Buffett has issued a warning that can't be ignored. Get ready to discover why this crash could be unlike anything we've ever seen. Warren Buffett is one of the most successful investors in history. He has been investing for over 70 years and has seen the market go through its ups and downs. But he is particularly concerned about the current market environment. He's also one of the most cautious. In recent months, he's been sounding the alarm about the stock market. In an interview with CNBC, Buffett said he's not a buyer of stocks. He also said he's concerned about the level of valuations in the market. Buffett's warning is based on several factors. Warren Buffett is not one to make predictions lightly, but what specific warning signs have caught Warren Buffett's attention? Let's explore. One of the things that Buffett is worried about is the high level of debt in the system. Both businesses and consumers are carrying more debt than ever before. This debt is a major risk factor because it could lead to a wave of defaults if the economy downturned. Another thing that Buffett is worried about is the level of speculation in the market. Much money flows into risky assets such as stocks and cryptocurrencies. This speculation indicates that the market is overheated and could lead to a crash if it unwinds. Buffett said he is not predicting a crash, but I think the odds are high that we will have a significant market decline in the next few years. He also said the next crash could be worse than 1929. If Warren Buffett is right and the stock market crashes, it could significantly impact your money. Your investments could lose value, and you could have a harder time saving for retirement. That's why it's important to be prepared for a crash. Here are a few things you can do. Ensure you have an emergency fund, which will give you some financial breathing room if the market does crash. Rebalance your portfolio. Ensure your investments are properly diversified so you're not exposed to any asset class. Consider dollar cost averaging, a strategy of regularly investing a fixed amount of money into the market, regardless of the market price, which can help you smooth out your investment returns and reduce risk. Despite the grim outlook, Warren Buffett offers some insights into how investors can navigate the impending crash. If you're concerned about the stock market, there are a few things you can do to prepare. Educate yourself. Learn about the factors that could lead to a crash and what you can do to protect your money. Have a plan. Decide what you'll do if the market does crash. Will you sell your investments? Will you hold on? Stay calm. It's easy to panic when the market is crashing, but it's important to remember that the market always recovers eventually. In a recent interview, Buffett said that he believes the stock market is overvalued and that a crash is likely in the next few years. He cited several factors that he believes are contributing to the risk of a crash, including high valuations. The S&P 500 is currently trading at a price-to-earnings ratio of over 20, which is historically high. Rising interest rates. The Federal Reserve is expected to raise interest rates several times this year, which could lead to a slowdown in economic growth and a decline in corporate profits. Rising inflation. Inflation is currently at a 40-year high, which could also lead to a slowdown in economic growth. There are a few reasons why a crash could be worse this time around. First, the stock market is more overvalued than before the 2008 crash. Second, the global economy is more interconnected than ever before, so a crash in one country could quickly spread to others. Third, the government has less room to maneuver to help the economy recover from a crash. There are several risks associated with investing in a crash. First, there is the risk of losing money. If the market declines significantly, your investments could lose much value, which could be a major setback, especially if you rely on your investments for retirement or other financial goals. Second, there is the risk of being caught in a panic sell-off. If the market starts to decline, there is a risk that investors will start to sell their stocks in a panic, which could lead to a further decline in the market, making it even harder to recover your losses. Third, there's the risk of missing out on the recovery. If the market does recover, you could miss out on the gains if you sell your stocks during the crash, which is why it is important to have a long-term investing horizon and not panic sell during a crash. Ensure you have an emergency fund, which will give you a cushion to fall back on if you lose your job or experience other financial hardships. Pay down debt. The less debt you have, the better off you'll be in a crash. Invest in safe assets, including cash, bonds, and CDs. Don't panic sell. It's natural to want to sell your investments when the market crashes, but if you panic sell, you will likely sell at a loss. To understand the gravity of Buffett's warning, we must first examine the current state of the economy. The level of debt is much higher than it was in 2008. The total debt in the United States is now over $30 trillion, more than twice the level in 2008, which means there is a lot more potential for defaults and bankruptcies if the economy were to take a downturn. The housing market is overvalued. The housing market is currently at an all-time high, and there are concerns that it is overvalued. If the housing market were to crash, it could have a ripple effect throughout the economy. The government is more likely to bail out the banks this time. In 2008, the government bailed out the banks to prevent a collapse of the financial system. If the banks were to fail again, the government would likely bail them out, preventing them from failing, but it would also put taxpayers on the hook for the losses. We can learn several lessons from the 2008 crash. Be careful about taking on too much debt. The level of debt is one of the biggest factors that contributed to the 2008 crash. If you consider taking on debt, make sure you can afford the payments, even if your income decreases. Don't invest in overvalued assets. The housing market is a good example of an overvalued asset in 2008. If you are considering investing in an asset, make sure that you do your research and understand the risks involved. Be prepared for the unexpected. The 2008 crash was a surprise to many people. If you want to be prepared for the next crash, ensure you have a plan, including having an emergency fund, investing in safe assets, and diversifying your portfolio. You can use several other resources to learn more about the 2008 crash and how to prepare for the next one. The Financial Crisis Inquiry Report. Congress commissioned this report to investigate the causes of the 2008 crash. It's a comprehensive and well-researched document that provides a wealth of information about the crisis. The Big Short. This book by Michael Lewis tells the story of a group of investors who bet against the housing market and made a fortune when the crash happened. It's a fascinating and eye-opening read. The Inside Job. This documentary by Charles Ferguson explores the causes of the 2008 crash in detail. It's a powerful and disturbing film that will leave you thinking long after seeing it. So, have you read any of these resources? What did you learn from them? So, what can you do to prepare for a potential crash? Here are a few tips. Start saving cash, which will give you a cushion to fall back on if your investments lose value. Pay off debt, which will free up more money in your budget so that you can weather a financial storm. Diversify your investments. Don't put all your eggs in one basket. Spread your money across different asset classes, such as stocks, bonds, and real estate. Finally, have an emergency plan, which should include knowing how you would pay for your living expenses if you lost your job or your investments lost value. Imagine a scenario where the stock market bubble bursts, wiping out trillions of dollars in wealth and leaving investors in a state of panic. If you're worried about a crash, there are a few things you can do to prepare. Reduce your risk exposure. If you have a lot of money invested in the stock market, you may want to consider reducing your risk exposure, which could mean selling some of your stocks and investing in safer assets such as bonds or cash. Be patient. If there is a crash, it's important to be patient. The market will eventually recover, but it may take some time. Look for opportunities. A crash can also be a time of opportunity. If you're willing to research, you can find undervalued stocks that could potentially provide big returns. So, what are your thoughts on Warren Buffett's warning? Do you believe the crash will be worse this time? Share your opinions and predictions in the comments section below. And as always, thank you for watching. Stay informed and vigilant. We'll see you in the next video.